Welcome to a pretty quick video, and this topic is discounts on sales. This arises with mostly business-to-business entities. There's two types of discounts on sales. There's trade discounts and there's sales discounts. What we're not talking about here is a sale like at the department store, but these are business-to-business agreements. A trade discount is a percentage reduction from list price we offer to important customers. For example, sell to an important customer at 10% off list price. Examples include senior discount, college student discount, frequent customer discount, and large customer quantity discount. This type of discount is reflected by recording the sale at that reduced price. Indeed, you could think of a sale at a department store as a trade discount as well. The bottom line is you simply record the sale at the price that is paid. Now, that is as opposed to sales discounts. Sales discounts refer to a reduction in the amount to be received by the company from a customer that pays within a specified period of time. Again, this is very common with business-to-business transactions. You'll often see it stated 210 net 30, which means you get 2% off as the customer if you pay your bill within 10 days and the full amount is due within 30 days. Sales discounts are variable consideration because the amount to be received depends on a future event, when the payment is received. There are two methods to account for sales discounts, the gross and the net method. Either method is allowed. The difference is normally not material. The net method is theoretically preferable because it records the receivable at the amount the company expects to receive in most cases. Since it is financially prudent to take advantage of the 2% discount, as a result, most companies do. In the upcoming case, we're going to demonstrate how both work, though, the gross method and the net method. We'll start with the gross method. Okay, so here's the case. Triton Electric offers credit customers a 2% discount if the sales price is paid within 10 days. Any amounts not paid within 10 days are due in 30 days. Thus, the terms are again 210 net 30. On October 3, 2024, Triton sold an electronic assembly to Responsible Contracting at a price of $10,000. And they sold one to Loopy Contracting at a price of $10,000. The electronic assembly cost Triton Electric $6,000 to manufacture. As usual, the terms were 210 net 30 for each customer. On October 10, Triton received a $9,800 check from Responsible Contracting. Since Responsible Contracting was paying within 10 days, they got to remit $9,800 in full payment for the $10,000 item they bought. On October 31, Triton Electric received a $10,000 check from Loopy Contracting. Loopy owed $10,000 because they were paying within 30 days, but not 10 days. So required is prepare the journal entries to record the transactions under the gross method, then the net method. Okay. Why don't you go ahead and take a moment and work this and then return to the video. Do both the gross and the net method and then return, and you can see my response, which you probably will get because this is not a difficult topic, really. Okay, welcome back. I hope you found that easy. So here's the gross method. Again, the gross method is going to record the receivable at the gross amount, the full amount, and then recognize the discount if indeed it is taken advantage of by the customer by paying within 10 days. So October 3, there's the entries. No surprise there, I hope. There is also the entries for the sale to Loopy. Again, no surprise there, I hope. October 10, under the gross method, remember, let's make a note here. Under the gross method, we recorded the receivable at the gross amount. Now, Responsible Contracting sends us 9,800. Put that in green because it's green being received. But it's in complete fulfillment of the $10,000 owed. So we debit a sales discounts account, which is a contra revenue account. Under the net method, we're going to record it at 9,800, and that will not be required. Okay, 1031, Loopy pays, and the receivable was on the books in the ledger at 10,000, and that's what they paid. So we zero out the receivable, and that's the gross method. Now let's see what this looks like under the net method. Under the net method, remember, we record the receivable at the net amount. And again, most companies are going to take advantage of it. So this is, again, the theoretical better way to do it to avoid the need to make the entry you'll see in a second. There's the cost of goods sold on each of the sales. And now we come to the new learning. On October 10, Responsible Contracting pays the 9,800, and that's what the receivable was on at. So it's in complete fulfillment of the $9,800 receivable, and therefore everything is correct in our accounting records. On October 31, Loopy pays the $10,000 they now owe because they didn't pay within the 10-day window. And so we actually have another source of revenue. We have a $200 sales discounts forfeited, which is plus revenue, an increase in a revenue account. And so the difference between the two methods is the net method records it, assuming that more often they're going to take advantage of it. And so we just record the additional revenue when the customer does not. Under the gross method, we record the receivable at its full amount and then record the sales discounts taken advantage of when they occur. Right, I hope that's pretty straightforward. And that is sales discounts on sales, and you'll see that a lot in your business-to-business customers and companies, clients and companies for the most part. All right, thanks for your attention. Have a great day.